Welcome back to the channel. I'm Andrew Lasky, commercial real estate investor and advisor focused on shopping centers and other retail assets. I frequently get asked this question: which types of shopping centers are the best to invest in? Look, if you're thinking about investing in shopping centers, it is crucial to understand the ins and outs of the different types because they're not all created equal. In today's video, I'm going to be breaking down the 7 most common types of shopping centers, from the smallest strip centers all the way up to the largest regional malls. We're going to cover typical size of each type of shopping center, the common tenant mix that you'll find in each, and the real pros and cons that actually matter when you're choosing which type that you want to invest in. Whether you're brand new to commercial real estate investing or you're looking to scale your portfolio, this video is going to help you identify which type of shopping centers are aligned with your investment goals and which ones you should completely avoid. And I know this is a long video, but if you stick around all the way to the end, I'm going to tell you about another type of shopping center that's a little less common, and it's actually one that I just recently invested in myself. Don't forget that if you find this content valuable, hit the like and subscribe button so that you don't miss when new videos are released. Now let's talk about the most common type of shopping center, which is the strip center. Strip centers are the smallest types of shopping centers that are typically located on busy intersections or busy roads that people take to work every single day. They range from 4,000 square feet to 30,000, and they usually consist of 3 to 10 bays that are leased up to neighborhood service businesses that meet either daily or weekly consumer needs. You'll find salons, dry cleaners, takeout restaurants, and tax preparation businesses in these strip centers, but you won't find major brands in these centers. And while they don't benefit from major anchor tenants to drive traffic, their visibility and accessibility make strip centers a staple in their local markets. Now let's talk about the pros of investing in strip centers. The first one is high cash-on-cash potential. Strip centers typically sell at a higher cap rate due to the perceived risk of not having an anchor tenant. In this new style of retail that we're seeing, strip centers have service-based tenants that are internet resistant, that generate steady foot traffic without having to rely on these larger anchor tenants. The second pro is that they often trade at a lower purchase price. This makes it accessible for first-time commercial investors to get in and learn the game. And lastly, strip centers have more leasing flexibility. These spaces are typically between 1,000 to 3,000 square feet, which broadens the pool of potential tenants that you can have in there. Now let's talk about the cons. Strip centers don't have a major anchor tenant, which means no guaranteed foot traffic coming from a dominant brand. The performance of the center depends heavily on the location and the visibility that it provides. Secondly, strip centers typically have tenants with shorter lease terms, between 3 and 5 years, with more frequent turnover. And lastly, they have limited credit tenants. You're mostly going to find mom and pops in these strip centers, making the income stream less predictable. Next on the list are neighborhood centers. Neighborhood centers range between 30 to 125,000 square feet and are anchored by retail, supermarkets, and drugstores that are designed to serve the surrounding residential population. These centers attract consistent foot traffic and are typically home to food, health, and basic service tenants. Now, what are the pros of investing in neighborhood centers? The first one is obvious: recession-resistant anchor tenants like Publix or CVS or Walgreens that attract consistent traffic regardless of where we are in the economic cycle. The second is higher probability of lease renewals by the other tenants. These tenants tend to stay longer once they're established because these consumers are coming to the center due to the daily need products and services that the anchor tenants provide. And lastly, lenders absolutely love these types of shopping centers that have major anchors, especially grocery stores. Now let's talk about the cons. Anchor dependency. If the grocery store leaves, the foot traffic in that plaza will absolutely plummet, and so will the occupancy hurting the other tenants. The second con is if one or two tenants make up 50 to 70% of the income, it puts your income at risk. And the last one that's not so obvious is anchor control. Sometimes these corporations decide what type of tenants can and can't go in the center next to them. I'm actually dealing with this right now on the deal that we're looking at, and we decided to pass due to the big anchor not allowing a lot of different types of tenants. Next on the list, shadow anchored centers. A shadow anchored center is a small retail center that's around 15,000 to 100,000 square feet that's located adjacent to a large national retailer. Think of Home Depot or Costco, but is not a part of the same ownership. These centers piggyback off of the shadow anchor's significant customer traffic without taking on the leasing or the operational risk that's associated with big box tenants. They often feature a mix of convenient-oriented service and food tenants. Now let's talk about the pros of investing in shadow anchored plazas. The first one is free foot traffic from national brands. It's obvious, right? Without actually owning the expensive anchor space. The second is strong leasing appeal. It attracts credit tenants who want to be next to these big box anchors that bring in the traffic. And lastly, you have lower exposure where you get to avoid the downside of having to replace a big box tenant. Now let's talk about the cons. You have zero control over the anchor's future. If the shadow anchor relocates or shuts down, your plaza will absolutely suffer from this. Secondly, is co-tenancy clauses. If that big store closes, those smaller tenants might be allowed to pay less rent, break their lease early, or renegotiate their entire lease. Lastly, cap rates can be misleading. Shadow anchor risk isn't always priced in properly. Make sure that you do not overpay. Next on the list are community centers. Community centers are mid-sized shopping centers between 125 to 300,000 square feet, designed to serve broader geographic areas than the neighborhood centers that we just talked about. They typically include multiple anchors such as grocery stores, gyms, or other big box discount retailers, as well as a wide mix of inline smaller tenants. These centers function as a one-stop destination for weekly errands and often include complimentary services and dining options. What are the pros of investing in community centers? Well, first is that they have a wide customer draw. They're a lot larger than neighborhood centers, and they pull in customers from further distances. The second thing is that they have anchor diversity. They're not just relying on a single anchor tenant, which dramatically lowers the risk. And lastly, they attract a mix of local, regional, and tenant credits, diversifying your tenant mix. Now let's talk about the cons. The first one is that you have higher turnover costs, especially for big box tenants. You could have 20 to 50,000 square feet sit vacant for months. It's also harder to reposition if anchor tenants leave. These big spaces require so much tenant improvement allowances that can eat your cash flow if you don't underwrite properly. And lastly, you have a limited buyer pool on the exit. Some institutions may pass due to the deal size, and they're often too large for many private buyers. Next on the list is the lifestyle center. Lifestyle centers range from 150,000 to 500,000 square feet and are designed to deliver an upscale luxury experience. They feature national and regional fashion brands, restaurants, wellness concepts, and entertainment options. You'll see lifestyle centers located in the most affluent suburban areas because these centers emphasize aesthetics, outdoor common areas, and a place where people actually go to hang out. What are the pros of investing in lifestyle centers? The first one is that they are built for customer experience. They have outdoor walkability, event programming, and dining. They draw people from all over the county, and they serve as a social destination. So what are the cons? First, they're highly sensitive to the economy, and they rely on consumer confidence and disposable income. Second is that they're very complex and expensive to manage. You have landscaping, public spaces, and branding costs that are massive. And third, they're very hard to fill vacant spaces due to the design restrictions and fewer generic uses. And lastly, this is a big one, they have massive common area maintenance costs that limit the leasing pool of the tenants that can move in there. Next on the list are power centers. Power centers are massive retail developments, typically ranging from 250,000 to 600,000 square feet that are anchored by multiple big box national retailers like Best Buy, TJ Maxx, Ulta, and Target, and have zero inline space for smaller tenants. Unlike the lifestyle centers, power centers are more functional rather than creating a customer experience. Now let's talk about the pros of investing in power centers. The first one is that you have high-profile corporate anchors that bring in predictable customers due to their national branding, which means that you have a lower risk of defaulting. The second pro is that they have massive visibility as they're located on busy roads or highway interchanges. And lastly, they have high land value due to the fact that they're located in prime locations with redevelopment potential. Sounds amazing, right? But what are the cons of these power centers? One anchor may make up 40% of the income, and re-tenanting is extremely difficult and expensive when those spaces become vacant. And secondly, their income can be drastically reduced to things such as e-commerce, especially if the anchors have soft goods or things like electronics. And number 7, we'll talk about the regional or super regional malls. Regional malls range from 400,000 to 2 million square feet and are largely enclosed shopping centers that are anchored by department stores and filled with dozens, sometimes hundreds of inline retailers. And historically, regional malls have been built as a destination shopping experience, but recently, these properties have seen a declining performance as consumer behaviors shift towards e-commerce and open-air formats like the lifestyle centers we were just talking about. However, some of these are being repositioned as mixed use or to create a friendlier customer experience. Now let's talk about the pros when investing in these massive malls. Historically, they have massive foot traffic as thousands of people visit these every single day. Secondly, they're located in prime locations and have valuable land for long-term redevelopment. And lastly, they support hotel, residential, and office add-ons where they can adapt the investment strategy as time goes on. So what are the cons when it comes to investing in these massive malls? These are filled with department stores and national retailers that are going digital, causing these stores to close down. You see it on the news. They're also extremely difficult to reposition as they have huge vacancies and expensive capital requirements. And lastly, you have a very limited buyer pool, mostly institutional or REIT buyers. And finally, if you've made it this far, here's the bonus that you've been waiting for. Are you ready? The last one is mixed use retail / office plazas. These aren't as common, but it's actually the type that I just invested in with my team. We literally just closed on it 2.5 months ago. Retail office plazas are hybrid properties that combine street level retail with upstairs office suites that really range between 10,000 square feet to 100,000 square feet. And these centers are often found in both suburban and urban areas or near hospitals and universities. These centers serve both the daily consumer and the local professional community, creating a symbiotic ecosystem between service retail and white-collar businesses. What are the pros of investing in these retail office hybrids? Well, the first is that they have a diversified income stream. You're not relying solely on retail or on office. One can offset the weakness of the other. Also, professional tenants often sign longer leases between 5 to 10 years, creating more predictable cash flow. Next, they have strong local demand in certain submarkets, especially if they're near healthcare, education, or dense residential zones. Lastly, they have zoning flexibility. Some municipalities encourage this format for smart growth and mixed-use walkability. The high parking ratios make them attractive for medical, dental, or boutique professional tenants. Now let's talk about the cons. The office component can be more volatile post-COVID, depending on the local market. Secondly, different leasing strategies and tenant expectations. When it comes to retail, they're typically used to triple nets. In office, many tenants want modified gross leases where they're just paying for electric. The third con is that they're harder to finance, especially if either the retail or the office part underperforms because banks prefer pure asset classes. And lastly, lease-up risk. The upstairs or office portion can stay vacant a lot longer without strong marketing or having the right broker in place. So there you have it. These are the most common types of shopping centers, ranked from the smallest all the way to the largest, broken down by what actually matters for you as an investor. Here's the truth. Not every retail center is created equal. Some offer stable, long-term cash flow with very little management, while others come with heavy risk, big capital needs, or declining demand. Here's why understanding tenant mix, lease structure, market position, and having the proper exit strategy is so crucial for a successful investment. If you're an investor looking to buy your first or your next retail property, or maybe you're somebody who wants to invest passively into a project, that's exactly what I help clients do every single day. Make sure that you hit the subscribe button if this brought you value, and drop a comment below about which one of these shopping centers is your favorite or which one you're going to invest in next, and I'll personally respond. I'll see you in the next video.